Most of us know that when we come to take benefits out of a pension, we usually have the option to take some tax-free cash out of the scheme and drop it into our bank account. Usually you get one opportunity to do this, and most people just don't think through their options carefully enough. But you are not, most people, because you're watching Meaningful Money. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK, and this video is brought to you by Meaningful Academy Retirement Planning. More on that in just a little bit. So let's cover the basics of how tax-free cash works in the two main pension regimes here in the UK. Taking defined benefit pensions first, these are the schemes where you build up a future income rather than building up a pot of money. You tend to find them only in the public sector these days, but there are plenty of old private sector scheme members out there probably watching this. And if you're in one, you'll probably know. These schemes often offer you a tax-free cash lump sum when you start taking your pension, but they usually also give you the chance to commute or convert some of your pension income into cash. So you get a lower income for life, but a bigger lump sum in your hand. Now, defined contribution pensions are the ones where you pay in, your employer does too, and you're building up a fund of money in your own name. And one day, you'll need to decide what to do with that money. Now, by default, you can take up to 25% of your pot as a tax-free cash lump sum. But in some cases of really old pension plans, you might have the option to take a bigger percentage. And these days, of course, you can access pensions very flexibly, and that gives you options. Now, whether or not you take your pension tax-free cash should be an intentional decision. Taking it just because it's there seems pretty short-sighted to me for a few reasons. With a DB pension, reducing your guaranteed income to increase your tax-free cash puts greater strain on your investments to meet your outgoings because your income is lower. As your pension will almost certainly be index linked as well, you're not just giving up income now, but all the future increases on the cash that you take out. With a DC pension, you're taking cash out of a tax-free environment, a pension, into a potentially taxable environment, such as a bank account. Now, you could ISA some of it, maybe even all of it. You could buy premium bonds. But even if you put it in a place which is free of income tax, you are definitely adding that tax-free cash into your taxable estate for inheritance tax. So yeah, it's potentially a more complex decision than just taking tax-free cash out of your pension because you can. So here are 7 potential use cases for pension tax-free cash that you might not have thought about. Well, chances are you will have thought about the first one. If there is lingering debt when you reach the age when you can access your tax-free cash, you might think about using it to pay off that debt, because that will leave you debt-free when you retire. Now, as ever, you could compare the interest you would save by paying off the debt with the possible but not guaranteed return you could make by leaving the pension intact. But most often, it comes down to the psychological value of having the debt paid off rather than the hard numbers, and that's particularly true with rising interest rates. Number 2, if you have a large amount of pension provision but not much outside of pensions, you could take your tax-free cash and redress the balance a little bit. Having money outside of pensions gives you more flexibility as to how you take that money and use it. So if you add the money to your ISA, then the money will remain tax-free, and that's always a good thing. And not only can you balance things up between your different accounts, pensions, ISAs, and other stuff, you could also potentially even things up a bit between you and your partner. Maybe you could pay into their ISA or even into their pension potentially, as long as you trust them. Okay, we're going to get a bit deeper into this in just a sec, but let me take just a short while to talk to you about Meaningful Academy Retirement Planning. This is my course that has got my best teaching on planning and executing a great retirement. But one of the best things about it is the community. So there's a private Facebook group only for members, and in there you can ask any question about the lessons or about how they apply to your specific situation. And my team and I are in the group answering questions, but the other members also weigh in. Everybody's just really keen to help each other out, and it's a really encouraging, helpful place to be. And once a month we have live Q&A calls into the group where you can ask me anything. And those calls are recorded and uploaded into the Academy, and we put in jump links so that you can go straight to the answer to the question that you're interested in. So check out meaningfulacademy.com/retirement planning, and if you decide that it's for you, use the coupon code YouTube for a hefty discount. I'll see you on the inside, and now back to the video. Okay, here are some more uses for pension tax-free cash. It is possible to use your tax-free cash to supplement your income. So if you don't need the lump sum, you could take some of your cash each month or each year and spend it. So for example, here in 2023, you can take £16,760 out of your personal pension, of which £4,190 is tax-free cash, and the other £12,570 is taxable income. But of course, if you've got no other income, maybe you've stopped work but your state pension hasn't started yet, then that $12,570 falls entirely within your personal allowance, so you pay no income tax at all. Now, if both you and your partner did this with your respective pensions, that's £33,520 you can earn tax-free. Number 4, you could also use your tax-free cash to defer taking in income from other sources. So maybe you take all your tax-free cash from your personal pension and then you spend that for the first few years of retirement. In so doing, you could delay drawing off the taxable part of your pension. You could maybe defer taking DB scheme benefits, maybe even defer the state pension by using the cash for spending. And deferring those pensions usually means that the income is higher when you do come to take them. Am I on number 5 now? I think so. I haven't numbered these. Number 5, if you're lucky enough to have a certain type of DB pension scheme, you may be able to have an additional voluntary contribution pension alongside it, an AVC. And this is just a DC pension, follows all the same rules as any personal pension does. But with some schemes, when working out your benefits from the main DB scheme, the scheme actuaries will factor in the presence of this AVC plan alongside. Long story short, you can take your tax-free cash entitlement from the whole scheme entirely out of the AVC pot. And what that does is it leaves more of your scheme pension income intact. This is the best possible outcome, right? Maximum cash, maximum income. If you don't know if this applies to you, definitely find out. Number 6, as I said right at the start, if you take tax-free cash from a DB pension scheme, it reduces your income usually. And that might be useful if you find yourself near the higher rate tax threshold. By opting for a higher tax-free cash amount, you could bring your income down below the threshold, thus saving some income tax. Be aware though that DB pensions usually are indexed, and as the thresholds are fixed for a few years yet, you might still end up over the threshold before too long. And then finally, number 7, while there are things that you can do with tax-free cash and tax planning that you might want to think about, please don't forget to enjoy it, at least to some degree. For many of us, this is a rare opportunity to take advantage of a lump sum of money, our money, that we've saved up, that to this point was locked away. And that's exciting, right? So if you've had your eye on a camper van, new car, major holiday, then those things are the great use for your pension tax-free cash. And so is making gifts to family or causes that you care about. Using this money is a great idea. Just make sure that you've thought it through and considered all the ways that your pension tax-free cash might be used. So lots to think about there as ever, and I hope you found it useful. If you have, then you know what to do. Please like the video, subscribe to the channel if you're not already, and maybe share the video with somebody who's thinking about their options at retirement. Thank you so much for watching. I'll see you in the next video.